A consistent structure is becoming clearer each week in how this trade conflict unfolds. The energy sector stands out as the clearest example of that pattern. The sequence repeats. Trump introduces tariffs. Canada responds. Canada then shifts strategy toward diversification. After that, Canada announces moves that appear to reverse the intended effect of those tariffs. In the most recent development, that pattern became especially visible. In the last 18 hours, Alberta and Ottawa jointly approved a new pipeline to Canada's Pacific coastline. The project is designed to move 1 million barrels per day of Alberta crude toward Asian markets and is being developed by Trans Mountain Corp. Oil price. COM described this decision as a break from the previous Liberal government's energy direction and as a clear sign that Canada's shift toward Asia is being backed by long-term infrastructure commitments rather than only diplomatic statements. This announcement came during the same week that International Trade Minister Manindender Sidhu led Canada's largest business delegation ever sent to the Indo-Pacific. The delegation included 300 companies. Speaking in Tokyo, he told the Globe and Mail that Canada is progressing toward Carney's objective of doubling non-United States exports by 2035. This follows approximately $33 billion in sector growth recorded last year. The broader context of this shift is what this analysis focuses on. It examines how Trump's tariff strategy has influenced Canadian energy flows, what the Hormuz crisis during February and March of 2026 meant for Asian energy security, and how that reshaped Canada's strategic role. It also looks at LNG Canada shipments, their destinations, and the expected development path for Phase 2 exports. Attention is also on the new Pacific Pipeline approval and what it signals for Alberta's long-term energy revenue outlook. Carney's discussions in China are also part of the picture, especially in terms of energy outcomes, but there is also a gap that remains visible. Experts point to the distance between Canada's stated ambitions and its current execution capacity, and they argue that understanding this gap is essential to evaluating whether the pivot is truly working or still mostly aspirational. The starting point is the figure that shifted expectations: $33 billion in additional non-United States exports added in a single year. According to Trade Minister Sidhu while speaking in Tokyo, this growth occurred while Trump's tariffs were in effect. The long-term target set by Carney involves doubling non-United States exports by 2035, which implies reaching roughly $300 billion annually. Based on current reporting from the minister overseeing the plan, Canada is moving toward that objective at a steady pace. Energy plays the central role in that $33 billion increase. After the Trans Mountain expansion, non-United States crude export volumes rose sharply. They increased from near zero prior to May 2024 to about 8.8% of total Canadian crude exports by 2025, based on statistics. Canada data released June 1st, 2026. This compares with 4.9% in 2024 and roughly 3% before the expansion. In volume terms, non-United States exports increased from about 12,000 barrels per day before TMX to around 39,000 barrels per day in 2025. A large share of that additional volume has gone to China, which has averaged about 7,000 barrels per day of Canadian crude since TMX expanded. This makes China the largest individual buyer of Canadian crude moving through the Pacific export system. The United States imposed a 10% tariff on Canadian oil and energy products as part of its pressure strategy on trade terms. In response, a significant portion of that displaced flow moved toward China instead. In February of 2026, the Hormuz crisis emerged, shifting the argument for Canadian energy in Asia from commercial advantage to geopolitical necessity. LNG Canada's shipments leave from Kitimat and travel directly into the North Pacific. From there, they reach ports in Japan and Korea in roughly 10 days. By contrast, LNG cargoes originating in Qatar and routed through the Strait of Hormuz and across the Indian Ocean normally require more than twice that time under stable conditions. During the Hormuz crisis, those same shipments risked not arriving at all. In March 2026, benchmark LNG spot prices across Asia doubled. Energy analyst Meredith Freeman of Poten & Partners stated that Canada's strategic importance has risen due to its proximity to Asian LNG markets. The Asia-Pacific Foundation of Canada offered a direct assessment. The West Ridge to Zosan route effectively resolves into a single pipeline and a single maritime corridor. They referred to this as the Hormuz problem. Under that framing, no Iranian drone can reach Fort McMurray or the West Ridge terminal. Trump's original approach to energy pressure is described as a blunt instrument rather than a refined strategy. The 10% tariff on Canadian oil and energy was imposed under the EA Emergency Economic Order. That order was later struck down by the United States Supreme Court in February 2026. Even at 10%, the tariff represented a significant increase in costs on one of the most price-sensitive commodities in the Canada-United States trade relationship. It applied to supply flows that Midwest refineries depend on for approximately 70% of their crude inputs. The underlying assumption in Washington was that the tariff would create leverage, encouraging Canada to accept trade concessions in exchange for relief on energy exports. Canada's response moved in a different direction. It accelerated diversification infrastructure that had already been in development. The Trans Mountain system was operating at nearly 90% capacity. LNG Canada Phase 1 delivered its first shipment in June 2025, marking what it described as a watershed moment. The Asia-Pacific Foundation noted that this milestone coincided with a trade conflict involving Canada's primary foreign energy market. Several additional LNG projects are advancing. Woodfibre LNG near Squamish is under construction with a target completion in 2027. Cedar LNG in Kitimat is also progressing. Casey Lissom's LNG project, backed by the Niska Nation alongside Shell and Total Energies as 20-year offtake partners, and with SEF of Germany now included, is targeting 12 million tons per year from northwest British Columbia. The Alberta and Ottawa Memorandum of Understanding in 2025 referenced an additional 300 to 400,000 barrels per day of Trans Mountain linked capacity, along with a new privately developed pipeline to the coast. That agreement has now been implemented. The newly announced pipeline, revealed in the past 18 hours, is designed for 1 million barrels per day. It is being built by Trans Mountain Corp, with significant Indigenous co-ownership and federal backing. It represents the physical execution of Canada's response to United States energy pressure. The goal is direct: build infrastructure to redirect oil exports to alternative markets and proceed with construction immediately. The Carney government's energy relationship with China is also a key component of this shift. It is considered one of the most significant bilateral energy realignments in Canada's modern history. It is also unfolding with less political resistance than expected, largely because the trade conflict with the United States has created space for it to proceed. In January 2026, Carney met Xi Jinping in Beijing in their first bilateral meeting. The two leaders announced a Canada-China economic and trade cooperation roadmap. That framework includes commitments to investment in both clean and conventional energy sectors. Global affairs: Canada later committed to raising exports to China by 50% by 2030. At the same time, China's crude oil imports climbed to roughly 12 million barrels per day in early 2026, marking a 16% year-on-year increase. A substantial share of that volume was directed into strategic storage facilities. China's refinery system remains one of the few globally capable of processing heavy, sour crude at the scale required for Western Canadian Select supplied through Trans Mountain. Following the Carney-Xi meeting, combined with the Alberta-Ottawa Memorandum of Understanding that referenced expanded Pacific pipeline capacity, the political barriers surrounding long-term Chinese offtake agreements for Canadian crude have been significantly reduced. In the LNG sector, Malaysia's state energy company Petronas participated in Canada's first LNG shipment to Asia, departing from Kitimat in July 2025. Canada also signed a letter of intent with Malaysia during the ASEAN summit in Kuala Lumpur in October 2025. That agreement covers LNG, small modular reactors, and renewable energy cooperation. South Korea, Japan, and India continue to act as active buyers of both Canadian LNG and crude oil. The Indo-Pacific business delegation of 300 companies led by Sea-Doo in Tokyo this week secured approximately $1.7 billion in agreements in Japan alone. Those deals included defense and renewable energy sectors. This reflects the commercial dimension of a broader diplomatic shift now supported by pipelines, nuclear cooperation agreements, defense partnerships, and structured energy supply contracts. However, the core assessment remains consistent with previous analysis. It requires acknowledging the gap between Canada's stated ambitions and its present capacity. Canada is currently the world's fifth largest natural gas producer, yet it ranked 19th out of 24 countries in LNG exports in 2025. By comparison, the United States set a record in 2025 by exporting 111 million tons of LNG. Canada, through LNG Canada Phase 1, exported approximately 4 million tons. This difference does not indicate failure in absolute terms. Canada's LNG export infrastructure was minimal before June 2025. But the scale of ambition is significantly higher. Targets of 50 million tons per year by 2030 and 100 million tons by 2040 have been described by the Globe and Mail in April 2026 as optimistic projections, rather than firm reflections of build-out capacity. Project additions illustrate the scale of planned expansion. Woodfibre LNG contributes 2.1 million tons. Cedar LNG adds 3.75 million tons. Casey Lissom LNG, if it reaches final investment decision and proceeds to construction, would contribute 12 million tons. LNG Canada Phase 2, if approved, would double existing capacity to 28 million tons annually. Combined, All projects that are either under construction or in advanced development total approximately 62 million tons per year, assuming full completion. That outcome depends on timelines that remain optimistic within Canada's regulatory environment for large-scale energy infrastructure. The gap between a potential 62 million tons and the 50 million ton target for 2030 is narrow. It depends on regulatory speed, final investment approvals that have not yet been secured, and ongoing Indigenous consent processes. The newly announced Pacific Pipeline faces similar constraints. The project would add 1 million barrels per day of export capacity, significantly expanding Alberta's access to global markets. However, it still requires permitting, financing, construction, and integration into export systems. Historically, such processes take years, even under accelerated federal frameworks. Canada possesses the resources and the market demand. The limiting factor remains the infrastructure required to connect them. That gap is now closing faster than at any previous point, driven by the urgency created by the trade war environment. Subscribe for more analysis on global energy and geopolitical shifts. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.